Hey, welcome back to the BYOB Square podcast, where we talk about becoming your own banker, financial literacy, education. We bring our favorite beverage to have just a conversation to share with everyone about our experience, our perspective. We're men in the arena just sharing how we see the world, and it hopefully benefits any of you out there that are seeking for a different path on how to take control of your banking function. So today we have a really interesting conversation. We're going to be talking about what traditionally financial planners talk about, the framework on how they view how you should use your money throughout your life. No right or wrong. We're just going to express a couple of ideas, how we think maybe there's a path that has worked better for us and that we continue to work through. Before we get there, let's go through a couple of things. First of all, as always, in our show, we'd like to highlight other businesses in our community because we think that the core of the economy, the core of progress for society is going to be small businesses that we make sure we support. So today we have Copper Canyon Law.
Yes, Copper Canyon Law, they're local to Mesa, Arizona. I met with them a little while ago regarding setting up a family trust, just to make sure that if anything ever happened to my wife and I, that stuff would be addressed and taken care of the way that we'd want it to, instead of going to probate or relying on a will. So if you haven't thought of estate planning or need just general information about a trust, I'd recommend chatting with these guys or a local attorney in your area, just to make sure that everything that you're working towards building is properly protected if and when you're not here anymore to service it.
Absolutely. Particularly if you use permanent life insurance. Yes, the death benefit is free. Yes, you get to assign your beneficiaries, but you want to have more infrastructure around that to make sure that, number one, your beneficiaries are protected in your absence, and number two, that there's a path there to generational wealth in terms of setting a structure that you can teach your children or whoever how to continue to be trustees of that capital. So highly recommended. And then the other thing I wanted to do was a quick recap, because I think it's important to continue to connect the themes that we bring up. This is how we're thinking about it, and there's a reason why we're bringing these topics in order to build on the conversation until we get to a point that we can start talking about strategies and so forth and so on. So last episode, we talked about wealth, and the three ideas that we wanted to leave you with is, regardless of how you define it, regardless how you think about it, you should have clarity about what it means to you. You should have a personal position on what wealth is, and you should take it from examples of people or entities that have success and bring the things of those examples that are beneficial or you perceive to be beneficial to you, that are good examples, good practices, and then evaluate what you have within your own thinking, and whatever is not serving you, let it go. But get clear about what wealth represents for you. The second part we talked about was, okay, when you talk now about a process to build wealth, what's the framework you're using, right?
Right. Yeah, I would say that this is the...
Let me turn on this laser here for you. There you go.
Well, I'm going to draw.
Oh, okay. You can draw here.
Let's figure this out.
There we go. You're good.
Cool. So this is the more of the what.
Let me help you one last time.
Come on.
There we go.
Here, all right. One more time. This is the what, this would be the how, and this would be the why. And those are what we argue you need to understand. So getting clear about the definition, what is wealth to you? How are you going to pursue it, and why are you pursuing that? Is essentially what it is that we're arguing you need to understand in order to facilitate this journey appropriately.
Yeah, that's golden circle theory right there. Understanding the why, we talked a lot about that for our framework, for example, on the ideal life. Abundance in all areas of your life is what we're pursuing, and that happens, that wealth funds the definition of that abundance in all the other circles. So absolutely, that's a great framework to think about why, how, and what. So let's clear here. Hopefully that was a conversation you found helpful for you. Today we're going to talk, like we said, about traditional financial planning, and we're going to introduce a couple of ideas. A couple of ideas that make this a framework on how we think about it. And we named this in one of our deep dive workshops, the traditional financial planning is failing today. So we're going to make that argument,
right?
And we're going to do it in the context of, okay, how do you think about how you finance purchases. A lot of times in conversations with clients, buying a car is the same as financing a car, and I'd like to make that distinction. Deciding to purchase something does not equate to deciding how to finance that purchase.
Right.
When you get to separate those two things, you'll start thinking like a banker. So that'll be one framework.
Yeah, after that, we're going to go into income versus expenses. So looking at what really is income, what really is an expense. How do we make sure that we rein those in, or how do we change how those affect our life, or how can we change our life in order to affect change in these areas?
Yeah, and right up at the tail of that is, so income and expenses, what is the difference then now with the difference between those two? A lot of people call those savings, but there's something to be very clear about, which is the definition of savings and investing should be different from each other.
Right.
So the difference between your income and expenses yields your savings, and how you deploy those savings, then that becomes investing. But those two things should not be intertwined, which is one of the issues we see with traditional financing planning today. People thinking that everything they have invested on a retirement account is savings. And there's nuances there that make it a significant difference.
Right.
Yeah.
And if your leftovers after your expenses are all going to some kind of brokerage account, that's not saving.
Not at all.
Because that we'll get into that.
Okay.
And then lastly, we'll talk about retirement, specifically around building up a nest egg versus building up cash flow throughout your life, and our argument on why you should pursue one of those over the other.
Yeah, absolutely. So let's get right into it. So we can start talking about the first point. The difference between purchasing something and how you finance that purchase. Nelson always talks in his book, Becoming Your Own Banker, that your need for protection is greater than your need for financing, is greater than you need for protection throughout your lifetime. And that idea is more profound than we normally give a chance to when we think about it. But if you consider everything you need to finance in your life, will include everything in your life with respect to housing, with respect to transportation, with respect to lifestyle, travel, enjoyment, health. So everything you purchase at the end, and this goes back to the core of the problem we are defining here, everything you purchase is finance, and unfortunately most of us finance those purchases with somebody else's bank, somebody else's money.
Right.
And because we don't take care of that portion of our internal economy, we're letting interest go to places that do not benefit our family or our business. And to get started in this conversation, the most common way to think about financing a purchase is using credit or using debt, right? And the debtor has a movement of money that looks like this. So we are trying to simplify, give you an idea, a visual on how money moves for the role of the debtor. This hopefully paints the picture of how you should think about from every time you make a purchase and you want to finance, and how it would work if you use debt. So I'll let you jump here in a second, but I'm just going to make this quick point for everyone. So when I think about this topic and I think about debt, all we're doing is starting at a zero balance, because we have not gone through the process of accumulating capital. We're using somebody else's money, and we're going to draw a balance here, right, to this level. Whatever it is, $1,000, $100,000, $1 million, it doesn't matter, right? And over time, with our future productivity, we're going to make repayments until we drive that balance back to zero.
Correct.
Right? That repayment is going to include part of the principal we borrow and interest we pay. Why? Because when we use somebody else's money that had the discipline of accumulated, the exchange of that requires that I pay an amount of interest for their ability to use their money.
Correct.
Right? Last thing, and I'll let you chime in. Over time, when we do this over and over and over and over, regardless of the amounts, regardless of the frequency, notice that when we use debt to finance every single purchase, we always go back to zero, zero, zero. So this is an equation, this is a behavior that always will tend to zero.
Right. And the easiest way to think about this is probably with a vehicle. You borrow $50,000, get a 5-year term, pay it off over those 5 years, then repeat this process. At the end of those 5 years, there's some equity left in that vehicle, but it's not the $50,000. It's a depreciating asset. Yeah. It's hopefully you bought it in a business and you can depreciate it on your taxes, so it actually you save some money there. And ultimately, there's not as much value as when you started. And so that therefore is kind of the danger of financing is you're not left with the true value that you financed. And the one maybe caveat to that is if you're buying a car, maybe it's a classic car and it's not going to lose its value. I'm going to bet that 99.9% of people listening to this aren't buying classic cars.
Yeah.
You know, real estate would be another example. You know, you almost always need to get a mortgage, and real estate tends to appreciate. You can affect its value. You can make improvements to it, things like that. So you're not going down to a zero valuation. However, you've got a 30-year amortization period, and over those 30 years, you're probably paying 2.5 to 3 times the actual value of that purchase in interest. So, you know, depending on your financing type, strategy, that kind of thing, you just have to be aware of what are the numbers. What does this look like long term? Run the numbers through an amortization schedule in order to see what the true interest cost is over that period so that you really understand where that money's going.
Yeah, and you make a valid point, which is we're not arguing here that debt, the use of credit, is bad or good because it's just a tool.
It is
right?
a tool. Absolutely.
If you're using credit for consumption, for things that are liabilities, based on the definition of Robert Kiyosaki, do they put money in your pocket or do they take it away? So if it's a liability and it takes money away, you better believe that every time you do this, you're not moving forward financially because you're just paying additional interest on what you're borrowing, which is taking away future productivity from your financial life. So we're not arguing debt is bad or good because in the opposite side of that equation, if I use debt to acquire a property that produces cash flow that appreciates,
Right.
the X value here when I finish the amortization schedule, you know, was paid maybe by a tenant, right? I use leverage to then acquire an asset that was more valuable. So that is not bad or good. That is a tool. If used properly, it's going to give you great results. But the point still stands. When you're using credit, you're driving that balance back to zero. It's an equation that you start over and over and over. So from the financial aspect of this, you're using future productivity to pay interest on the money you hadn't accumulated. That's why you're using somebody else's money. Right? So this is just a visual to paint the role of financing, the role of debt, the role of creditor in someone's financial life. Now let's take a look at the opposite. What about cash? Cash then becomes the conversation, well, I don't like debt. I like using cash because then I don't have to pay interest to anyone. So how do you think through that?
Right. Well, with cash, you know, you're putting off that purchase until you save up the lump sum to make that purchase.
So there's a component here of time. Oh, excuse me. There's a component here of time.
Yes, sir. So we've got to build up that pool of capital. Then once we make that purchase, we're depleting that capital. And then, you know, there's an opportunity cost to that of what if we saved up the $50,000 for a vehicle, for example, and a property came around where the down payment was $50,000.
Yep.
Well, now we don't have any cash in order to acquire that property that could make us more money, things like that. So, you know, there's one, the opportunity cost. Two, you lose the compounding. So if you're saving, let's say you put this in a high yield savings account at 2%.
Right.
Even 2%. If you take that withdrawal of the cash out of that account in order to make this purchase, well, now you've stopped the compounding of that money over time. So there's another opportunity cost. So essentially, spending cash is opportunity cost.
Yeah. And this is a concept that takes a while to understand, but I think that the brilliance of this visual is that you're going to have the discipline to accumulate money with your future productivity over time. And no matter the balance, at some point, if you use that cash straight up, you're going to draw from that cash and you're going to tend to go back to zero when you make that purchase. And that money will never earn interest over time. So it's a huge cost. It's invisible to people because they say, well, I'm not paying interest in the future. But what about the interest you could have earned over time for that money? And if you do this over and over and over and over, guess what? You're still tending to zero, right?
Right.
Regardless if the balance is 1,000 or if you had the discipline to save 1,000,000. So these two things, which I think is interesting, is overlaid. Both behaviors, regardless of when you stand in the camp of I only use debt, I only use cash, maybe you need to elevate yourself and get a perspective where you realize that these two things are opposite sides of the same coin.
Right.
And again, nor bad or good. But we have to ask the questions, how could we get the best parts of using leverage, and how could I get the best parts of capitalizing my cash, combining a method that maybe is better, maybe the banks are using, maybe the wealthy are using, maybe corporations are using. And that's the type of thinking we need to start elevating ourselves through. It's not either or, but how could I make this better?
How can we leverage the value of the cash without truly using the cash in order to keep that compounding going but still have access to the capital?
Absolutely. And this is when we get to the basics of, okay, when we take over the banking function in our lives, we get to decide what process we're going to use to have money flow through us and apply to the right platform, which we argue again is permanent life insurance, specifically high dividend paying whole life insurance policies. We get to use that because of the virtues and the qualities of that asset class. We want to, like you were saying, create let's change this color to this green. Create the opportunity to not interrupt the compound. Oof, that is awful.
That's not a good green.
There we go. We want to make sure we get our money compounding on a curve, right? Compounding year over year actually produces an exponential curve that looks like a hockey stick. And we would never want to interrupt that, because every year we allow that compounding, guess what? Gets better, gets more efficient.
Right.
But it's undeniable that we still need access to capital to finance the needs of our life. And in this type of arrangement, we can access both, because we are going to use our money in a platform that allows us to keep it there while borrowing the custodian of that money, the capital there, so we can do the transactions we need to do of large opportunities like buying assets, real estate, or even large purchases in our life. And then as we finance that, when we complete the amortization payment of those loans, we find ourselves at a larger balance than we were before.
Right.
Especially if we're in the later year of that behavior. So.
Yeah, it's the compound effect of the more time that we can give the machine to work, the higher the result's going to be. It's something that keeps coming to mind is the individual who started, and again, we'll talk about retirement accounts later, but for sake of argument, you've probably heard the story of the person who started putting money away in their self-directed account at 23 versus 30.
Yeah.
By the time both of them retire, one's got like something silly like 2.5 times the amount of money as the other guy, and it's just 7 years. Yep. So looking at the true compounding of funds over time, understanding the opportunity cost, how to leverage debt, how to utilize cash appropriately, when to use one over the other, or how do we mix them, things like that. It's just so important to understand in order to make sure that, further on down the line, we're able to obtain what we want to obtain, have what we want to have, and not just look at the I want it now. How do I prepare myself now to be there?
Yeah. What you're saying, it goes back to Becoming Your Own Banker, the book by Nelson Nash. I've been talking a lot about this actually this week. 2 principles that remind me always to ground myself, which is don't be afraid to capitalize today, meaning I really need to protect my capital, and a portion of everything I earn is mine, so I should be keeping it in savings. And number 2, think long term. And I think that, again, such a simple statement, but so misunderstood, because the human brain cannot understand the power of an exponential function. That's all it is. It goes back to the conversation about a penny that doubles every day for 31 days. Would you take a million or the penny? It's just so hard to see that at day 27 you surpass that million. By day 31 you're over 5. It's just so hard to see. But nonetheless, if we don't visualize the process of cash and credit, and we go back, get out of that conversation, I do cash, I do credit, and you just realize that you need a process to understand how you can leverage both the compounding of your capital and having access to it, is probably going to be the path to get more efficient, like banks, like the wealthy, like corporations do.
Right.
Okay. All right. The second topic we were going to talk about, and I think we're just going to discuss this. So now we've talked about how money moves, cash or credit, or maybe there's a better path. Now let's take it to the practical individual. So we've talked about in the past, the average person in America, out of their 100% of income, most of their income, 90%, will go to expenses. And then if we're being generous, 10% will go to savings or less.
Sure.
Right now the savings rate is of about 5% and dropping, right?
Right. So
in general, that understanding means that all we're going to do is create income, send the money away, 90% away in expenses, whether it's transportation, housing, living expenses, whatever it is. And then we're going to keep only 10 or 5%. And what we decide to do with that money is the scope of conversation for financial planning. And they'll tell you, oh, we'll help you reduce expenses. But in reality, this scope of work is that 5 to 10% of their income.
Right. Yeah, the traditional financial planners look at what's left over and tell you how to utilize it, as opposed to looking at, can you increase your income? Can you decrease your expenses? Can you do a mixture of both? Because just about everybody out there is able to somehow increase their income.
Right.
And obviously there might be some kind of consequence to that. It could be a time consequence. It could be a startup cost consequence. And we have to maintain the long-term perspective of, okay, if I need to work 5 extra hours a week in order to make another $100, $20 an hour, how is that $100 going to work for me over time? And can I turn it into something? Can I pay off my high interest credit card faster in order to save interest costs? Can I put it into a properly designed life insurance policy? Things like that. And I'm guilty of wanting the shortest workday possible in order to spend the most time with my family. So I take a different approach of how can I maximize the time I have being self-employed in order to make as much money in as consolidated amount of time as possible. And that's where Nelson also argues controlling your employment through, and he had a lumber business, and he's able to control that lumber business because he's the owner-operator. And he can hire people, he can have control over that whole environment, therefore affecting change as necessary in his own income.
Yeah.
So not saying everybody should go quit their 9-to-5 job in order to be an entrepreneur and self-employed, and yet, is there something you could do to get some more money on the side? Can you start even driving for Uber or something like that to make some extra coin and somehow make that transition, if it's within your scope of understanding, your skill set, things like that? Can you make a transition in order to increase your income in order to then maximize your savings, your investing, your insurance to make sure your family's protected later on, things like that, as opposed to just I'm going to go do my 9-to-5, be complacent in life, and I've got my 5% left over that I'll put in a rainy day fund.
Well, and I hear you. Obviously, you're very passionate about increasing your income, and I love that because that's definitely the mentality I've transitioned myself into. Is like there's more likelihood of creating abundance by growing the ability to serve other people and grow my income than trying to compress myself into less expenses, and that's a fabulous point of view. I want to open the scope of that to make sure that we address everybody, because some people may want to do a 9-to-5, right? So,
there's a lot of security there.
Absolutely. So regardless of what your values or your focus is, I think Josh just said something really important, which is the point I was trying to make. Is like, if you just focus, again, on what's left after expenses from your income and you want to maximize savings, you're going to take the traditional financial planning approach. But if you zoom out and you realize that 100% of the income you earn is 100% of the money that flows through you, there's other things to be done. Yes, you can reduce your expenses to make that 10% 15 or 20 or 30. Yes, you can grow your income so the whole 100 gets bigger. You now have a bigger portion of income. Internally, if you want to make no changes, just realize that even in that 90%, a lot of the money that you're sending away is either costing you interest that you're not earning because you're using cash, or you are financing purchases and you're paying interest to other banks.
Right.
In other words, the interest that you are losing or paying could be part of the portion of the money that goes to your savings if you make your overall financial world more efficient.
Yeah, and I mean, it goes back to this whole scenario of even if we take that 90% of our expenses, how can we filter that money through this in order to not lose the compounding? If we can't make any more money, we can still get this curvature over time through this type of setup in order to still maximize the longevity of our money, still maximize our retirement years. I hate that word, retirement. And, all of this, like you said, just shifting that flow of money a little bit, shifting our understanding a little bit. We could put all of our living expenses through this type of scenario in order to still get the compounding over time.
Yeah. So practically, what are we talking about? If you're using credit cards, you're paying interest. If you have a mortgage, you're paying interest. If you have a car payment, you have an interest. I'm not saying you take all over that and put it inside a system or do you change overnight. It's going to take you time. But the opportunity is there that if you're paying 25, 30% on interest on a credit card, maybe you should take over that banking function so you can use your capital, let it compound, and then access the capital you need to make repayments on whatever debt you're using. So again, just another concept for you to even consider. Am I being efficient in the way my income and expenses yield a certain amount of savings? Am I happy with the amount of savings I keep, or do I want to increase it? And then am I being efficient in the way my expenses are financed? What I purchase is different than how I finance, so just remember that.
Right.
And that leads me to the third point we're trying to make, which is, okay, we talked about there's debt and cash and how money moves, and perhaps there's a better method to do that to make sure that money compounds and that I have access to it. Step two is, okay, there's income and expenses and savings, and I want to make sure I maximize my savings by creating more efficiency in the rest of my life. Now, the point that comes after that is, okay, once I have savings, I need to get very clear about what that capital represents.
Right.
And in financial planning traditionally today, there is a miscommunication about the fact that investing savings and savings are the same type of capital. And I would argue that it is not.
Nope.
It is not. So we need to get clear about the difference between savings and investing. So
Right.
what would you say about that?
I would say that your savings account should be 6 months of your normal living expenses. And that's there in case of emergency. If somebody goes in the hospital, the car breaks down, heaven forbid you're laid off or fired, like you have 6 months of your normal expenses in the whole month's expenses, not just your mortgage payment, like your true cost of living expenses, 6 months of that in an account, buying you time in order to get back to normal, back to employed, back to the cars operating again, and that kind of thing. And whatever you use, be very mindful of. Make sure that you can refill that pool of capital. But that savings account should be intended for basically the oh crap fund of something happened, we need cash fast, and we don't want to pay interest on it.
Yeah.
So that's what I would argue your savings should look like. The investing goes back to the old adage of don't invest what you can't afford to lose. So if you've got that 6 months rainy day fund set up and you have money left over because that's filled up, now it's overflowing, well, where do we direct the overflow? Do we go to a brokerage account and buy stocks, bonds, ETFs, things like that? Do we go and save up for a real estate transaction? Do we go to seminars in order to further our learning so that we can make better decisions in the future? Arguably, the best investment you can make is in yourself. So are you continuing your education in these areas that can help you financially? And how is that then going to further your life? So all of that would be an investment. Are you investing in yourself? Are you investing in something that's going to lead to increased capital in the future?
I agree. I think that it is very important, at least for ourselves, to have clarity about like the difference between savings, investing, speculating. And the way I like to think about it, for example, is I think of savings as the amount of capital that I cannot afford to lose. Therefore, I'm not going to introduce any risk.
Correct.
And second is the amount of capital that I don't want to part from. I don't want that money to go away from me. I want it to be as close, as liquid as possible, because that's where I'm going to tap in when I need that kind of money.
Right.
And I differentiate that now to the next step from investing, which is, okay, now I have excess capital, and I want this capital to go out and work for me.
Right.
And I recognize that out of just savings, that's not going to be the solution for abundance. That's not going to be the solution to winning the money game at all. So savings has a particular role. It's my baseline, it's my foundation, right? And when I have excess capital from there, and you need to decide, is it 3 months, 6 months, a year. Josh's is 6 months, but you need to define what's your level of comfort for the amount of capital you need to have in savings you won't part with. And then when you have excess from that, then we enter the conversation about investing. How can I go and put money to work when I'm willing to part from it for a period of time, and where I can control the amount of risk by understanding how the investment works, by keeping control over the investment, so I can guarantee the return of capital with additional capital to calculate a return on investment.
Right.
That is a very calculated specific set of parameters that is different from the third part of it, which is speculation, where I just send money into the roulette and I hope the roulette gives me 10 times back.
Right.
Right?
Yeah, the difference between speculation and investing is control and knowledge. It would be, and we've covered this in previous episodes, but investing is you understand the risk that's being taken. You understand the purchase price, the expected value in the future, everything that happens in between. But speculation would be, well, so-and-so said that this should go up, so I'm going to buy it.
Yeah.
If you're not doing any of your own research to understand that particular investment, or if it's in the stocks, the company that you're buying in, looking at their financial sheet, their history, making sure that that is a good company to invest in, even going as far as looking at the board of that company to see what kind of decisions are they making, because that can obviously affect the future performance of a company.
Yeah.
So that's where I tend to stick personally with real estate, because I understand it. My knowledge on real estate is superior to my knowledge on stocks, bonds, mutual funds. So by definition, if I go invest in stock, for me it's going to be speculation.
More risky, yeah.
It's more risky. Do I understand at some level what I'm doing? Yes. However, because my knowledge is inferior to my knowledge of real estate is the better avenue for me. Yeah. Now, if I wanted to go buy Dogecoin, Bitcoin, Ethereum, any of that, well, that's even below stocks for me, because I don't understand how cryptocurrency works. I don't understand the value of it and where that value stems from. It's really no different than the Fed and our money here in America, but it's deregulated. There's no intrinsic value other than what you might say it's worth, or they say it's worth.
I understand.
So, that's the whole speculative environment is, well, it's been going up, I think it'll still go up.
Yeah.
And then it crashes.
I guess, all there is left to say is, once you get to the point of you understand the money that's left after expenses on your income, you need to decide, okay, how much savings should I keep? 3 months, 6 months, whatever it is. And remember, that's money you don't want to part from. You don't want to introduce risk. You cannot afford to lose. So where are those savings going to reside to be protected, to be available, to be liquid? If you're going to then move forward with the investment, make sure you align that with your ability to control it and your knowledge. And if there's excess from that and you think that there's room for having speculation because there's so much upside to that speculation that is worth, make sure that your position is right for that. It shouldn't be 100% of your savings.
No.
It should be a portion that you think is, okay, if I were to lose that money, I'm okay with that, but it was worth because the upside was so great. So getting clear about what those rules look like in your life is really helpful. And again, I will say one more thing about traditional planning, and this is my personal experience. Because and this is to one of our early episodes, because my relationship with money was non-existent. I was outsourcing that relationship to somebody else. Somebody else was the quarterback of my life. But nobody can quarterback your life like you if they are a different person than you, because they don't have your values, they don't know what's best for you. You need to realize that regardless of what you do with money, the first thing that probably would be the most valuable would be to engage in a relationship that's healthy and that you're constantly nurturing by educating yourself. And I'm not advocating for not having advisors at all. I think advisors are very, very, very useful. But those advisors are throwing at us ideas that we need to contrast with our own thinking, with our priorities, with our values. And I also would say that when we get clear about savings, and we then put a certain amount of money, let's say that you want a retirement plan or you want a brokerage account and you have an advisor, the portion of that money needs to be clear about what it is, whether it's investment or speculating, and if we're going to let that person run with it or if we're going to be involved. But that doesn't mean it's 100% of our savings, which is what I see constantly. The intertwining savings and investment is going to, unfortunately, confuse you more if you don't get clear about what that money really represents and how you can continue to grow it. So,
right. So we need to clearly define savings,
Yeah.
clearly define investments. And when we do invest, don't just take your advisor's word at face value. Make sure you understand where that money's going, whether it's stocks, bonds, mutual funds, real estate, gold, silver, anything, whatever that investment is. Make sure you understand it, because if you don't understand it, it's speculation.
Yeah, absolutely. So hopefully that helps set our framework of how we're thinking through, okay, why is financial planning traditionally failing and not educating us in a way that we can clearly understand these steps? The last step I would bring up is what we talked about. Okay, let's think retirement. We like to call that passive income time, regardless of your age. It's just our construct of how we think about when you decide maybe to take a break from your productivity. How is your money working for you if you're not working for money?
Right.
And two of the major schools of thought here are, okay, let's build a nest egg through my working years so I can accumulate an amount of capital, and then I'm going to deplete that capital as I use it at the end of my life. Or, hey, maybe we buy cash flow through our productive lifetime. Let's buy assets that work for us, and they get more efficient, more productive over time, right? So when I decide to go into passive income stage of my life, that cash flow continues to come with me, creating more and more abundance. Obviously, you can see that we advocate for that because that's what banks and the wealthy and corporations do. This is what $7 trillion in retirement accounts today are doing.
Correct.
And this is what I was doing with my life before I started to shift my thinking. I think that it's really hard for me to see how this actually will be a path to the abundance that we're talking about.
Right, and we've got a deep dive into the whole 401k retirement type planning and why the biggest beneficiary of a 401k is actually the government, which, you know, that should get everybody's hair on the back of their neck standing up. But yeah, going back to the scarcity versus abundance, the nest egg versus cash flow, control versus lack of control. If we're accumulating the nest egg of $2, $3, $4 million, whatever we want to call it, you know, you're building up to this X million dollars with the mindset of, well, it's going to keep going up at an average rate of 4%. So if I withdraw 4% every year for my cost of living, then I'll be okay. Now, where this generally fails, one is there's a lack of control around the actual value of the portfolio. Typically, this is a 401k IRA where somebody else has been dictating all the decisions, the stock picks, you know, the dividends that might be getting paid on those stocks might be predictable, but the true value and therefore the withdrawal percentage is in flux. And that's where there's then risk in the retirement realm of, if my portfolio was $4 million last week and then something happens in DC that affects the stock performance and now it's $3 million, well, that's a 25% difference. And I don't know about you, but if I had a 25% hit, therefore, my living expenses, I had 25% less cash due to the withdrawal rate for my living expenses, that is huge.
Yeah, it's going to reduce a quarter of your lifestyle. Yeah,
right.
I mean, it's huge, of course.
Yeah, and if the golden years are supposed to be, you know, playing golf and traveling the world and things like that, well, now I'm playing a 9-hole cheap course instead of the, you know, nice 18-hole.
Yeah.
And what was the point of retiring if I can't do what I want? So that to me is one of the big issues with the nest egg, is the lack of control, the inability to access the capital until you're at 59 and a half. There's pending legislation to increase that number, which is even scarier. So that would be the scarcity mindset.
Before you move on to cash flow really quick, like, as always, we're not advocating for this is bad or this is good. This is just our point of view, and we're pointing out things that we observe in a given process.
Right.
So if you've had the discipline, for example, of saving in a retirement account for the last 20, 30 years, congratulations. That is really amazing, because most people do not have that discipline. And I think you should recognize that the things you were doing had an impact that is positive in your life. All we're trying to argue here or just discuss is, okay, if you've been following this path, does it really lead to the vision, the things that you want in terms of abundance in the future? And if not, maybe there's little steps that you can start taking to add things to the process where you can transfer some of the capital you've accumulated to a regime of cash flow versus continue to create amount that you're going to deplete over time. Because in a world we live in America today, number one fear for baby boomers is running out of money in retirement age. Mm-hmm. That is not just a fact that we just throw. That is the reality that 72 million people in the United States live with in terms of fear. And if we want to have an ideal life or we want to have an abundant life, right, that is probably the exception. But we continue to do the same things that 72 million people in a generation did and expect a different result. That's insanity. So we need to start thinking how, wherever I am in the journey, whether you're 20 years old or 55, how can I transfer the capital, the productivity that I've had and I stored in my savings in a place where I can now start accumulating additional cash flow for me to accelerate my path to abundance. So I hope that is clear.
Yeah. To reiterate, if you did this and it's working, that's phenomenal. Congratulations.
Absolutely.
And so many of us, myself up until a couple of years ago, thought that this was the only way to do things. Yeah. And that's going back to the whole problem of education around money is we're here to help provide another avenue. I'm not going to stand here and sandbag anyone who's been putting money in an IRA because, again, like you said, it's the discipline of doing that. It is fantastic that they've done it, that there's funds there, and how can we help?
Yeah.
And that's where we're going to look at the cash flow. Oh, I lost it, David. That's where we're going to look at.
It's not working still?
Oh, that side. I got to use the right side of the pen. That's where we're going to look at the cash flow. And I'm very passionate about this because I got started in real estate investing pretty early on in life. I would argue that cash flow over a nest egg is much better because there's more control, there's less risk, there's increased leverage, and this is particularly around real estate. And I became a millionaire in real estate at the age of 28, and I did it through focusing on cash flow and long-term appreciation. And looking at that, it was if I put the $20,000 a year into the retirement account, maximize that, or if I put $20,000 towards saving up for real estate, when I had enough capital in that account, then I could afford the down payment, and now I have cash flow coming in, I've got appreciation of the property over time, I've got depreciation on my taxes. If you do it right, the depreciation is going to be pretty close to your cash flow, so on paper, it's a net zero, so there's no taxable income from the real estate, the rental property.
Yeah.
So, looking at this, it's, okay, let's buy a property, buy another one. How do we keep doing this over time? See that? Now I flip the pen and it doesn't do it. But how do we keep doing this over time in order to build up this cash flow curve so that when we hit 65 or whatever time where we want to be financially free, well, now instead of $4 million in stocks, I have $4 million of net worth in cash flowing real estate, and I've got life insurance to back up the outstanding balance on any mortgages I have so that if I die, my wife, my kids, whoever's inheriting the property, can use that life insurance money to pay it off and have them free and clear.
Yeah.
They could use that money to go buy additional assets. So it's a different perspective of how do we shift the money that was going here, how do we use it to purchase cash flow?
Yeah.
And there's properties out there as inexpensive as $50,000 that you could go buy cash and generate $800 a month in cash flow, which is pretty significant.
Let me pull it back because You can tell, obviously, like the difference. What I hear you, when I hear you talk, that comes to mind when I talk to clients is this is a lot easier if you're going to outsource a job. It doesn't require you to do much other than, okay, I'm gonna have the discipline to put the money here. I'm gonna let somebody else manage. It's okay that they get fees.
Right.
They don't understand how that works. It's okay that the government is making maybe a greater rate of return with the money they're helping me for retirement accounts that are tax deferred, yada yada, right? But this is not a conversation of engaging with my own money. Even if you're reading prospectus of the mutual fund, like you're not engaging with that. And the challenge to get here is what you're just describing. You got engaged with money, so you became the person capable of talking about all the things you're talking. If it goes well, is my education. You had to do work to build this. And I think that that's the part that either we need to get excited about in becoming that person capable of having cash flow be created and flow through your life, or if you just want to go back to comfort. I think that that's probably the psychological aspect of this. And the second thing you pointed out is like, you're purchasing properties here, here, here. Let me remind you of the graph we were reviewing before. As the cash flow grows, you want to make sure your money continues to compound, and you want to have access to the money so you can use it in the next property, and the next property, and the next property. There's alignment here with when we talk about taking the function of the banker in your life.
Correct.
And taking the function of the person that creates cash flow, because those things are the same thing.
Right.
That's why banks, again, create cash flow by what? Creating loans, buying the best real estate in every downtown and every city in the country, right? By putting money to work so the money comes back with additional dollars. Cash flow, right? They are using that same behavior, but they're telling us to buy the products that put us in this behavior. Give us your money, we'll give it to you in the future, we'll try to grow it, and then you'll be able to use it, and hopefully you don't run out of it before you die.
Right.
I think we need to get in the business of doing what banks do, not what banks are telling us to do. There's a huge difference.
Absolutely. And again, like my example is real estate. There's so many different things.
Your own business.
That you could do. It could be building your own business. It could be being a lender.
Yeah.
Lend out your money. If
Absolutely.
you don't want to go buy the real estate, well, just understand the investment and be the lender on it.
Absolutely.
You could finance vehicles and have
In
a
your own
lien on
family.
title.
Absolutely.
In your own family or in
As
your
a business.
community, as a business. So really the sky's the limit on ways to create cash flow. And I would argue it needs to be something that you understand, that you're passionate about, that you have some level of control over, and that isn't going to be too difficult for you.
Yeah.
Because I think when things become too difficult, we lean towards the ease of saying, just go do it for me. So where can you get started that is somewhat simple? And it might not be on your own. Who can you partner with?
Yeah.
Who do you need to know in order to help with this?
Right.
Because there's real estate agents, there's financial advisors that lean towards cash flow.
Yeah.
There's plenty of friends and family that you could partner with on things. I've got a partner on half of my real estate holdings.
Yeah.
Why? Capital is one thing. We're able to pool our capital together in order to scale faster. But two, it's I want their knowledge, I want their
leverage.
experience, I want them to help me understand the deal in a way that I might not be looking at it. So I have no issue partnering on things because there's value in that other individual and what they also can analyze, bring to the table financially, et cetera. So just change your thinking a little bit. And what can you focus on? What can you do that isn't going to be a huge burden of time? Capital, can you get creative with raising capital for a business or a real estate deal? Yeah. Because I've borrowed 100% financing on real estate purchases. Well, how do you do that?
Yeah.
Creative
financing.
Creative financing, seller financing, rich uncle, somebody who has a big life insurance policy with good cash value that'll be the lender on it. But if I have 100% financing and I make $1, well, that's an infinite return on investment for me. I put nothing out of my own pocket into it, and if I make a penny, that's an infinite return.
Absolutely.
So just changing the perspective, changing the analysis of investments, and taking ownership over it, I think is the biggest transition to growing wealth, making sure we get away from the scarcity and into the abundance. And coupling it with a properly designed life insurance policy is going to give us the leverage, the flexibility, the security if something were to happen to us, that our family's cared for. All of that is just fantastic.
There's a reason why banks do this.
Yeah.
I keep coming back to that thought. There's a reason why the most successful money flippers in the world do this. And I hope this conversation is helpful for that reason and that reason only. Just question what you're doing today. Is it serving you in your best interest? And if it is, I am so happy for you. We are happy for you. And I'm sure there's ways to continue to improve. So if you want to learn more, feel free to reach out. We're happy to share our experience, our resources, in hopes that it brings value to your life. If you think that the paradigm, the system, the process that you're using is not serving you, go back to the video and watch that 4-step thinking. Is the way that I am differentiating between purchasing and financing, and my understanding of financing being the difference between debt and cash, is really working for me, or do I need to introduce a new understanding to that for me to understand how financing really works in my life? How can I continue to keep my money earning income, interest compounding without interruption at the same time I have access to it? That's number one. Number two, okay, if income and expenses generate savings, what is that ratio and how can I make that more efficient? Do I grow my income, reduce my expenses, take the expenses, and all the interest that's leaving to other banking systems can go back to me so I can increment the level of savings in my life? Number three, typical financial planning will want to introduce in those savings as much risk so they can maximize the growth. I would argue that maybe you need to get more efficient and get clarity about what that difference is between savings and investing. How much should you keep of capital that you're not able to lose, that you cannot afford to lose, so you can protect it and you can always have it available and liquid? And then with the excess, how can you go and invest in things you understand and control so you can actually guarantee the return off capital with a return on investment?
Correct.
The fourth thing and the last one is, hey, overall strategy, zoom out. Are you working towards creating a nest egg that you're going to deplete over time and not create generational wealth or just run out of money? Number one, fear of baby boomers. Or two, are you going to maybe introduce some new steps, new processing in your life where some of the money you go out and invest creates cash flow, which is going to get efficient over time and is going to produce more abundance in the future? I will leave you with this last thought. Small businesses in the United States represent the majority of businesses in America, over 90-something%. And the statistic from the Bureau of Labor is that the medium, meaning 50% of businesses have less, 50% of businesses have more. The medium level of liquidity for a business to make payroll and to live is 16 days.
Wow.
50% of those businesses, thousands of businesses in the United States, only have 16 days or less of liquidity to manage anything that's coming to them. Payroll, expenses, supplies, right? There's a huge need in this country for understanding how savings and investing works, how to create cash flow, how to separate the difference between how to finance and how to purchase things. So hopefully this is valuable for you to evaluate your framework and maybe consider that there's possibility to make it better.
So David, and this will be another video I'm sure, but if I'm taking what you're saying correctly, we can do this with a business?
And you can do this for a business. This is not an individual conversation. This is not a family conversation. We're talking about how money moves through your life. And your life includes your relationship with everything around you, including your community, which includes your business. So if your business is flowing money through it, and you're sending it all away to different banking institutions or different people, and you're losing an interest that you could have earned, or you're paying interest to somebody you had debt with, and the amount of money that you save for the business is very small, there's a way to make it more efficient, just like you could do it for yourself or your family. Absolutely.
Wow. All right.
Let's make that a future conversation. But for now, hopefully today was a valuable conversation for your life, for your family, for your business. We'll see you next time.